Good morning. Welcome back to the Global Capital SRI Forum and to this focus session on ESG-labelled bonds. My name is Lucy Fitzgeorge Parker. I'm the editor for Sustainable Finance at Euromoney magazine. I'll be moderating the discussion today, and I'm delighted to be joined by a very experienced panel of speakers. So I'll start by asking them to introduce themselves and say a few words on their relationship to the ESG-labelled bond market. Heike, could you set the ball rolling? Oh, Heike, you're on mute.
Happens all the time. Okay, hi everyone. My name is Heike Reichelt. I head the investor relations and sustainable finance team in the World Bank Treasury. And we are responsible for the issuance of bonds by the World Bank, International Bank for Reconstruction and Development, that's been in the market for over 70 years. And also IDA, International Development Association, an organization that just entered the bond market a few years ago. And both issuers raise funds in the capital markets to finance development projects, sustainable development projects in emerging markets, and issue sustainable development bonds. So that's our relationship to labeled bonds. What we finance is all for positive impact. The World Bank also issues green bonds. Back to you, Lucy.
Well, Carlos, maybe you could go next.
Thank you very much. Good morning, everybody. My name is Carlos Martins. I'm a senior portfolio manager at the European Stability Mechanism. Of course, Europe is at the front runner in this sustainable finance discussion. And of course, this discussion is at the heart of any financial market participant. So, of course, we as an investor with over 80 billion of paid-in capital, 80 billion euros of paid-in capital, we of course look at use of proceeds bonds as an important tool to also channel our ESG considerations. And I must say that with over 4.7 billion of use of proceed bonds in our portfolio, we are a quite reasonable investor in this area. And obviously the discussion will go much beyond pure use of proceeds bonds, and I think this we'll discuss today. But we must also acknowledge that sustainable finance is not a one-way and a one-lane road, so we have a lot to discuss just beyond the use of proceeds bonds. Thank you.
Fantastic. Stephen?
Morning. Thank you for having me. My name is Steve Libertor. I am the head of ESG and impact for global fixed income at Nuveen. So basically our public markets operations. I am our lead PM for all of our strategies that are dedicated ESG and impact. Manage about 17 billion in total assets, 7 billion of which fit into our proprietary impact framework, of which the labeled green social sustainability bond market would be a main proponent or a component of what we invest in. We've been pretty active in the market since, probably before they were called green bonds, which probably just an easy way for me to say I'm old. So we appreciate the opportunity to participate today.
Fantastic. Thanks, Steve. And Petra?
My name is Petra Wehlert, and I'm heading the capital markets business at KfW. KfW has an issuance program of 75 to 80 billion this year. And a major part of that is issuing green bonds. So our mission was when we started 2014 with green bonds to move this market out of niche into mainstream, meaning we now issue benchmark sizes for our green bonds. So we have one green bond outstanding with 6 billion in size. We issued this year a Euro green bond 4 billion in size. So it's a growing segment in KfW. Yeah, and therefore it's pretty interesting also to monitor the developments overall in the segment. And that's what we do. And I'm curious to discuss here with the participants the development of the ESG labeled market.
Fantastic. And last but not least, Shrey.
Thank you, Lucy. So my name is Shrey Kohli. I head up debt primary markets at the London Stock Exchange. And within my responsibilities, I lead the LSE's sustainable bond market. The LSE was one of the first exchanges to set up green bond segments, not as early as the World Bank and KfW started issuing green bonds, but back in 2015. And that market has obviously evolved to include segments now for both use of proceeds bonds and sustainability-linked bonds or bonds which are linked to the general balance sheet of the issuer. I also run our investment funds markets, which have seen a variety of closed-ended funds raise capital for purposes which fit within sustainability, whether they be energy efficiency, battery storage, renewable energy, or efficient infrastructure. So very keen to participate in the discussion today, and thank you for having me.
Fantastic, thank you, Shrey. And just one more thing before we get into the discussion, we will have time for some questions during this session. So if you have any for our speakers, please do let us know. You can submit them via the chat box on your screen, and we'll get through them, as many of them as we can, in the next 45 minutes. So with that out of the way, on with the discussion. Now, the full title of the session today is ESG-labelled bonds, an ever-expanding universe. And that in itself reflects the biggest recent shift in the market, as not so long ago we would have been talking, as some of the speakers already have, about GSS bonds, green, social and sustainable, or as they're now known, use of proceeds bonds. And the big change over the past couple of years, and particularly the past 12 months, has been the rise of sustainability-linked structures with penalties or rewards linked to key performance indicators. And so far, the buzz around the product hasn't quite been matched by deal flow, but a lot of bankers are tipping this to market to grow exponentially. And so I guess maybe the question I'd like to start with is, is all the hype around sustainability-linked structures justified, and are sustainability-linked bonds really the future of ESG-labelled debt? Shrey, perhaps you could kick us off.
Thanks, Lucy. So, I mean, it'll certainly be a component of the ESG bond market in the future. And look, to take a step back, unlike Stephen, I'm from the millennial vintage of people within capital markets. And look, my career has been bookended by the financial crisis on one end and the pandemic on the other. It has been a paradigm shift to see the growth of the ESG bond market in the last 5 years. Discussions that we would have with corporate treasurers, for example, have moved substantially from what's the benefit in terms of a pricing percentage, or what extra are we paying to investors to issue a green bond, to how is this tied to our strategy. And what the sustainability-linked instrument allows you to do is to tie your general corporate balance sheet, as you mentioned, Lucy, to what is a longer-term strategy for the issuer. Now, we're quite lucky in the market to be guided by the Executive Committee for the Green Bond Principles, or Green Bond, Social Bond, and Sustainability Bond Linked Principles, which have set the market standards. So there are standards now for the market to apply when issuing the sustainability-linked bonds. And to some extent, this should mitigate any fears of greenwashing, although it is a market at the end of the day, so investors have to be careful about what they buy. But to see more issuers enter the market in industries that perhaps previously didn't participate, cement, for example, more so in the energy industry as well, has certainly been of interest. So we're watching this market very closely.
Heike, what are your thoughts on this? Sustainability-linked bonds, are they the future?
I think it's an evolution. Maybe there was some hype because it was a new instrument a few years ago. But like any market, you need a variety of products. One thing that I did want to point out is the name sort of misses a little bit of the key feature of the product, which is that it's performance linked. So it may be a product that is general use of proceeds, but the return to the investor is somehow linked to something that the issuer or some other way that the bond is structured. And for me, it's a product that will coexist with the current use of proceeds bonds and other bonds, a little bit, like we have in the market. We have very large liquid benchmark bonds, and then we have structured products. And there are investors that purchase both. There are investors that focus only on one. So I think it's a good evolution in the market. I think it's important to get all issuers involved in part of the market, to get all investors involved. And if there are some issuers that can start engaging with ESG focused investors in this way, I think it's good. But we'll talk a little bit more later about sort of what's important to the development of the market. But that's my initial view.
Petra?
Yeah, I wanted to pick up also what Shrey said. I think it's pretty important that we now have, or that last year, the sustainable linked principles were introduced. Just because, you know, if you compare it with the green bond market, you need a kind of reliable infrastructure for a market to grow. And I mean, actually, if you look at the growth in this market, in the SLB market, it has started with that. Because, I mean, investors now know better what the framework is. And that reminds me a little bit to the start of the green bond market. On the other hand, I think, well, if you look at what we do in the green bond market, we have very much put our emphasis on liquidity and benchmark bonds, because investors in the SSA market, and this is, you know, central banks, bank treasuries, they very much have a focus on that. The question of diversification of products is something which comes later in the addition to that. And I mean, what I like with the SLB product is also that it's a kind of holistic product with an issuer view, institution view, and that is something which we get reflected in the green bond market from investors too, that we are now at a stage where investors very much look at that. And this is something we very much appreciate. However, well, as Heike said, it's a kind of structured market. Issuers and investors look at it as a structured product. And this is something which might prevent really the growth, which could be comparable to a kind of green bond market. But on the other hand, it unlocks more issuers. I mean, because many issuers have a kind of bottleneck regarding the green assets. That's something which we monitor. So therefore, on that front, it could help and could be, a development for the future.
Carlos, maybe you'd like to respond to that, as obviously you're closest to the sort of regulatory side.
Yeah, well, I mean, still an investor, and I would give you the perspective from the investor. From what I see now, first of all, let me start by saying that the ultimate goal of all of this is to have a better world, and we're very happy that this is achieved. Whether it's through use of proceed bonds or other kinds of instruments, I think the ultimate goal is being achieved. It's very, very interesting to see how the investor community and how the financial market agents are participating into this. Now, that being said, and as I said in the beginning, this is not a one-lane road, and we have a multitude of different options that are appearing. And we have supply and demand, and we have to adjust. The investors need to adjust to the supply, and the supply looks at what investors are willing to do. What I see in green bonds and use of proceeds in general bonds is that it lacks the flexibility that the performance-linked bonds have. On the other hand, those kind of general purpose financing instruments, indeed, they lack maybe the harmonization, the standardization that the green bonds have. So in fact, there are both different instruments that have advantages and disadvantages. And I would say that the fact that the performance-linked bonds specifically or other similar instruments are self-instructed, it lacks, or it may represent an agency problem, and will develop into, I would say, a deeper appearance of ESG rating agencies like we saw in the past for the credit rating agencies, and we see that happening quite often these days. Probably the appearance or even resurgence of the third opinion parties. We also see things like auditors coming back to that, because the regulation, as you mentioned correctly, is developing to that too. So from our perspective at the SM, we are taking a holistic approach in which we take issuers instead of products as into our assessment. And to that regard, it really doesn't matter what kind of products is in it, but it does matter the level of ESG alignment, if you will. Into the regulatory side, if you like, Europe is doing a huge step towards this standardization by introducing the taxonomy. And this, for me, in terms as an investor, will help saying and looking and analyzing and assessing how a tool or how an asset is regarding the objectives defined by the Commission in this specific case in terms of taxonomy alignment. And I think the standardization, regulation, and clear objectives from the regulators will help put a more level playing field, I would say, and a more harmonized environment in this market.
Okay, well, Steve, I've come to you last because I know that you have very strong feelings on this. So please do tell us about your views on SLBs and use of proceeds bonds.
Sure. I think I'll start with the positive. I think it's definitely a good thing anytime an issuer, regardless of market, is contemplating how their operations and impact the environment. I think that the issues that we have had, with the way that the SLB market has developed has been more, I would say, along the lines of execution than it is in theory. We are very much a proponent of use of proceeds because we know our investors are asking us to direct capital specifically to issuers, projects, technology, pools of assets that we know are going to contribute to a greening of the global world, of the global economy and of the world as a whole. And the use of proceeds bond really provides that as an option. It also, provides us, now that we've seen the growth in the social bond market, is we've seen various issuers come to market to address COVID relief and various other social inequities that we are now talking about more, globally. That's a real positive. And I think our investors are looking for us to be able to, deliver to them, first and foremost, return, but then secondarily, this, direct and measurable impact that we're able to then allow them to see how their capital is being deployed. And I think the use of proceeds allows for that to occur in a far more, a far more efficient manner. And I think the challenges that we have around SLBs from our perspective really revolve around, are the targets really aspirational enough? We've seen deals where, the KPIs have already been met by the issuer, are the penalties associated with not meeting them really disincentivizing enough to ensure that the issuer is going to meet the goals. And what we have seen, and the KPIs can be anything, as we've talked about before this particular panel, but we've seen pretty much them all focus on some form of carbon intensity. And then the question even becomes, is carbon intensity the correct KPI? Because you're more efficient in creating greenhouse gases doesn't mean that's a positive. So it's really more of a challenge in our mind that you're missing the real purpose. And I think that there's still a lot of confusion in the marketplace, especially for investors, when they see a labeled security. This is a sustainability linked bond, and full disclosure, I'm on the advisory council of the Green Bond Principles, and I was on the initial executive committee. So this is the only security that's been given a label that isn't use of proceeds. And I think that investors still are confused by that. And, the last comment I'll make is that as an investor that's focused on dedicated ESG and impact, when I think about how the SLB market is currently structured, if and going to give positive credit for all of these things, that if the issuer really is going to meet these goals, then we're going to pick that up in our ESG evaluation, right? It isn't, and so we're going to see that, and that's how we're going to be able to evaluate whether or not that particular issuer is improving from a, in this case, an environmental perspective. So it seems a little bit as though it can be a little confusing, I think, to investors to kind of start interjecting sustainability linked in discussions with use of proceeds and making it seem as though they're equivalent, when the reality is they are not. As an investor for a standard SLB, you've written a 25 basis point call option to the issuer for them to actually execute something. But yet when I hear people discuss SLBs, most people will describe them as a commitment from an issuer. It's not a commitment, it's an option that you've sold to them to create a commitment sometime in the future.
Heike, you wanted to respond to Steve.
Talking about sort of the market and evolution. I hear what Steve's saying, and I actually think that sustainability linked bonds or sustainability performance linked bonds shouldn't be a replacement for use of proceeds bonds, and that probably will be seeing some sort of merging. So even issuers who issue sustainability performance-linked bonds will be communicating what they're using the funds for. So I don't think it should be an excuse not to be transparent about what you're using capital for. I think that, you know, as Steve was saying, engaging with investors around ESG is just going to be expected for any issuer that's in this market overall.
And I guess Steve, what you're referring to is the lack of incentives and perhaps some of the weaker KPIs. What do you think could be done to improve that? Do we need regulation to improve the KPIs? What sort of incentives might be meaningful?
Yeah, I think that you could do a couple of things, and this is the feedback that I've provided during engagements with issuers and underwriters around it, and I think it becomes less appealing to the issuer when they hear these types of comments, right? I think truly, and I'm going to make this completely up, right? A truly aspirational goal, right? That if today is the T+0 measurement period, that in the next 5 years I'm going to reduce my carbon footprint or intensity by 50%, and I'm going to be measured every single year along that path. And if I'm not on the run, if I'm not meeting that target, and obviously the simple math would be the 10%, that's not exactly right, but I'm meeting that 10% reduction every year. If I don't meet that 10% every single year, my coupon is going to double. That to me is an aspirational target, and also an incentivizing structure to ensure that the issuer is going to meet that particular goal. And I think that another concern that I have about it is in discussions that I've had with issuers and underwriters is that one of the big drivers or proponents of why we have seen SLBs grow so much has been because issuers feel as though, well, I don't have as many projects. I can't issue a true index eligible green bond because I looked around and I have 200 million worth of projects when I really want to do 300 million. So I'm going to do an SLB. That's the whole point of we're trying to encourage issuers to become more green, more socially aware, more socially conscious. So the point would be to try to find aspirational opportunities to change your operations. And so to say that, well, we have to do an SLB and not a use of proceeds because we don't have enough projects, that's the whole point. You need to look around to see how you can transition, change your business or your operations, whatever type of issuer you might be, to find those additional opportunities for projects and growth. And ultimately, at the end of the day, what I think philosophically to me is a challenge with SLBs is that if ultimately what you're telling me is you're trying to improve, your own carbon footprint or your own operations to be more sustainable, there have to be underlying projects that get you there. And there have to be underlying investments that get you there. So why are you not issuing a true use of proceeds bond in order to encourage that investment and that focus? Because one of the things that we know for certain, and one of the reasons we invest the way that we do on a direct in use of proceeds basis, is when we think about the simple ones, solar, wind, those are technologies, there's no fuel costs associated with them. So the more investment that's made into solar and into wind, for example, the cheaper they become for the next person and the next issue. And that's a way to really provide an absolute benefit to the climate, is by driving down continually the cost of those renewable sources as examples, and driving down that cost of capital makes them more cost competitive, which indicates going forward more investment will be made into them.
Okay, fantastic. Well, I think everyone has something to say on that. I'm seeing a lot of electronic hands raised. Carlos, I think you were first.
Sure. Just a quick comment, and I fully agree with what Stephen was saying. And I think it's important to mention that this is clearly a financial option embedded into these performance-linked bonds. And of course, it's only exercised if it's in benefits of the issuer. And this must be kept in mind as an investor. From the investor point of view, it's also interesting to say that although it looks like a cheaper option, a cheaper funding option for an issuer, it does not have the architecture needed to issue a green or a social bond. it's not cheaper from an investor point of view, because the investors, they still need to do their homework. They still need to do their due diligence. They need to have the assessment on the issuer. So the discussion about whether one or the other is preferable, it's not the right one. It's more, is there space for the two, and is there enough supply and demand for the two? And I think the market is still settling down on this story. And maybe I'll just relate to a question that I saw passing from the audience regarding the taxonomy, because I really think that this will be one of the key answers to this problem of, let's put it this way, the companies that need to be more ambitious on their targets. And if you put together a taxonomy, like we are doing this in the European Union, and in Europe in particular, we will define, or we have defined, the 6 environmental goals, and this will be done at economic activity. This is the unit of measure, is the economic activities. So these objectives will be measured per economic activity. This will not be a standardization of the green bond market, although there is part of the taxonomy that will be dedicated to the what's so-called the European Green Bond Standard, which is still in the making. It's still not out there. But the taxonomy is not about the green bond specifically. It's about economic activities. And in that sense, I think will help a lot putting together, when companies come out with their goals, how much these goals are aligned with the goals that politically are defined. And this will help investors make the comparison necessary to make their choices.
Trey.
Yeah, Lucy, I mean, I guess the one addition to Stephen and Carlos's comments are that this is still a very nascent market. So for example, on the LSE sustainable bond market, less than 1% of all issuances are sustainability linked. The rest of them are user proceeds. So we do have to be conscious of the fact that it's only been a few years. Stephen and I are on the advisory council, and one of the discussions that we had, because as market structure experts, we always think about this, is should the penalty in terms of the step up be linked to the average spread in the secondary market so that it is commensurate to the liquidity of the instrument? But still, I feel that that's a little early. But it's good that these conversations are happening now, because they really, from my perspective, is a movement from ESG as a niche to ESG as BAU. This is critical to your business strategy, right? Investors are now having a conversation with companies that if you are aiming to reduce your carbon footprint by 50% from a 2015 benchmark, why have you picked a 2015 benchmark? Why aren't you picking a 2020, 2021 benchmark? What are your interim targets? What are the projects that you're funding to reduce their carbon intensity? Is there any additional significant harm with your business model? Will we be buying your bonds if there are other activity you're conducting, even though this is a sustainability linked instrument? Could you not issue a use of proceeds bond together with a sustainability target, performance target, as Heike alluded to earlier? And some issuers have chosen to have a use of proceeds framework in addition to a sustainability performance target. But the additionality aspect of sustainability linked bonds is important as well, because now those sectors where are critical to the transition to, away from 51 billion gigatons of carbon dioxide being emitted annually to zero, are now part of the conversation around raising capital through sustainable finance. And that is a major change since the advent of this instrument.
Petra.
Yeah, a couple of points in my head, actually. I mean, it depends on also from the issuer side, what kind of issuer you are and which segment you are. I mean, if you have enough assets, as I mentioned at the beginning, and you can do liquid use of proceeds bonds, it's more you work on the pricing incentive, and then it's quite obvious for you as an issuer. I mean, you can reach all investors and you can achieve better funding levels that you work on that front. But if I put my market hat on, and this market, the ESG-labelled bond, it's also one of the visions to develop that further. Then you need ways to develop it and to get other issuers involved. And yes, best case is they do have assets to sell, but if they don't have at the beginning, so I do think that transformation is something which is worthwhile to support. And I mean, if I look at demand and supply, I do really see that on the investor side, and I mean also overall in the European market, there is simply a lot of money to be invested. And then I think it's somehow, for me, it's a step in between well, we might end up at use of proceed bonds at some point. But at the beginning, sometimes it's necessary to make a step back. So it somehow reminds me that actually, before we entered into the green bond market, we said, we have these ESG ratings, and having a holistic view, this is the best instrument you can have. But at a time that was not really accepted, and capital market participants not really had a view on that. And with the green bond market, we achieved that everybody has now a closer look at it. And also the importance of the ESG ratings is higher these days. And so I think it's indeed a transformation which you do. And from an issuer point of view, if you issue an SLB bond, I mean, I would hesitate to do that if I don't have to. If I have enough credibility in the market, there is no need for me to commit myself, right? Because I can communicate what I do and I feel committed to that. But if I have to implement that as an embedded option, there might be some reason for me to have a better access to capital markets. And the good thing is then that moves things forward in a positive way. So that's what I think is something which is a good development.
Well, one thing about the use of proceeds versus sustainability-linked debate, of course, a couple of years ago, before the sustainability-linked instruments really started to take off, people were talking a lot about transition bonds as the way to bring more issuers into the use of proceeds market. That's gone a bit quiet, certainly in Europe. I know there have been a few in Asia more recently, and a couple in the Middle, at least one or two, I think, in the Middle East. I mean, Shrey, do you think that transition bonds do still have a place in the ESG-labelled market?
So I think it takes me back to a point made earlier in this conversation where, I think Carlos made it. We certainly don't see the proliferations of labels being a zero-sum game. At the end of the day, what you want is, companies which may have higher emitting models, at least in the climate space, to be looking at pathways towards reducing those intensities so that we can meet our targets under the Paris Agreement and restrict ourselves to a future where we're not subject to intense climate change. That being said, the debate itself has evolved from transition being a use of proceeds label to transition being a theme, at least in debt capital markets, right? And within the launch of the Climate Transition Bond Handbook last year by the Executive Committee of the Green Bond Principles, I think it's a very clear pathway which is now set for issuers to say, you could issue a use of proceeds bond, or you could issue a sustainability-linked bond. And if you wish to have an overlay to define how it's a transition-themed bond, meeting your Paris Agreement targets, having additional disclosure, and providing an additional issue-level strategy to investors, you're able to do so. On the equity side, it's quite interesting. My colleagues in our index part of the business have worked with entities like the Transition Pathway Initiative and the Net Asset Managers Alliance to create transition-themed indices now, which look at the quality of disclosure and intensity of carbon pathways. So I think transition as a theme transcends just debt markets or equity markets. It goes very closely to the business model of the issuer, and that's not going to change.
Oh, Carlos, I guess transition is a bit of a dirty word in an EU context, is it?
No, it's not. I think it's crucial to understand that it's a double-edged sword. It's obvious for everybody that transition is absolutely necessary, and companies are screaming to be allowed to make that transition. But on the other hand, the decision makers are forcing the hands of economic agents to make that transition faster. And that being said, I'm not sure if there will be enough space or time for that kind of transition bonds to flourish, because I believe that in terms of regulation, in terms of political willingness, it's all pointing towards greener, completely green projects, completely socially supportive projects. And the transition, I'm afraid, is being left behind. So probably the message, and probably this will settle down somewhere in the middle, but the message is hurry up, because we're not going to waste much time on the transition side.
Thank you.
So transition is an incredibly important topic, and that's one of the reasons why my colleague Colleen Keenan is also on the transition working group of ICMA, as well as other working groups. We definitely need transition finance. And I mean, labels, we've talked about them, this is what the panel is about, are a very useful way for issuers to communicate to investors what they intend to use the proceeds for. And what their strategy is. So it's a matter of transparency. That's what it boils down to. And if some issuers feel that a transition label is, how they can best communicate what they're doing, there are clear guidelines from the ICMA about what they should focus on, what's expected, and it's important. And, we're not going to solve the challenges. I definitely take Carlos's point that we don't have time, but we can't only focus on the greenest of the green because we have to do things now, and we have to make sure that we have a transition. And, in the previous panel, there was a lot of discussion. I was happy to hear that. Also about local context, about emerging markets. And I just think we have to be realistic, and it's important, as I said at the beginning, to get as many issuers into this sustainable finance market, and some will be sort of in it as part of the transition.
Well, Steve, you're very keen on use of proceeds bonds. Does that extend to transition bonds as well as the more standard ones?
Yeah, absolutely. And I think the real challenge, there's a couple of problems, or not problems, there's a couple of challenges, I would say, within the transition space, is that, for us, when we think about and evaluate transition securities, that's a pretty high bar, right? That is something where we're looking at an issuer who's truly trying to transition their business and their operations, or whatever it is, not necessarily a business, but they're trying to transition their operations to being more sustainable. And that's a difficult thing to get accomplished. So you have to have an issuer who's really willing to look hard at their own operations, be truly aspirational again, and be willing to try to see how they work and how they operate in a completely different way. And that can be a challenge, obviously. And simultaneously, you need to have the investor base, and the buy side is a key component of this, be willing to look at issuers who are trying to do things differently. And in a lot of cases, the buy side's unwilling to do that, in that an issuer is, in some ways, we've evolved away from this exclusionary screening process to best of industry class. But in a lot of cases, the buy side is unwilling to evaluate, certain industries or certain types of technologies for inclusion in their portfolios because of maybe some historical negative, connotations around it. And that, I think, is something that has to be evaluated and addressed. But I think that there's a lot of opportunities there. And also, I think we need to think differently about what the word transition means. I've had, conversations with, pretty much every major, oil and gas E&P issuer, over the past 24 months. And what I think is an interesting conversation I try to have with them is all of them at this point have made material investments into renewables. It's either solar, onshore wind, offshore wind, geothermal, distributed generation. And I encourage them to try to issue out of those subsidiaries as a form of transition finance, because I think what we want to do is, again, going back to my previous comments about driving down that cost of capital for renewables, but also what it does is probably expand out their investor base and provide the opportunity for the issuer to talk about how they're trying to transition their business away from the use of a finite resource of fossil fuels. And so I think it's those types of engagements and conversations that are critical to be had, but it really requires everybody to think a little bit differently about what their current positions are and how do you move beyond that into an opportunity to provide financing for more sustainable operations.
Thank you.
I have a very quick comment. Shrey mentioned earlier that 1% of what's listed in London is sustainability performance-linked bonds. The labeled bond market is less than 2% of the total bond market. So we have to have a complete change in how we're thinking about this in the market and tackle that other 98% and look at that also more holistically. So I think that's what we really need. Everything is good. It's about communication, harmonization, and transparency. But we really need a more holistic view of everything that's being issued in the markets.
Shrey.
Yeah, I mean, Heike made a very powerful point right there. And I mean, just to give you a little bit of flavor of what the discussions are about the local context, so we've seen this year the intensity of climate change from the perspective of just temperatures, right? I grew up in Delhi, 45-degree heat was normal, but air conditioning was not, right? The discussion in Asia is how do you go hand in hand with developing jobs for people at an adequate temperature and provide cooling, but sometimes cooling can lead to emissions. So how do you square that circle? That doesn't mean to say that that's what transition finance has to address, but those are the economic challenges that we're facing. And at the end of the day, private sources need to provide capital for such economic development. Now, if there's a tool to allow within a taxonomy, a framework, the provision of cooling or heating in an efficient manner or using alternative technologies in the future that may not even exist today, would that be beneficial to us as humanity? Potentially. But what transition as a label, I think, allows you to do at this moment of time is address that 98% of the market, as Heike says, which doesn't operate within the sustainable finance space, right? We're reaching $1 trillion of GSS-linked bonds issued this year, but global capital raised within markets exceeds 20 trillion on an annual basis. We want it to be a majority, or at least reach a majority in the near future. And as a label, we certainly feel transition as a theme allows for that.
Petra?
Yeah, I think we have to develop at the same time the product world and also the holistic approach. Because if we enlarge the product world, we get more investors involved. We have more publicity about what corporates are doing, what issuers are doing, and then develop from there a more holistic view. So what we also do is we approach all our issuers in our portfolio, because we are also an investor, and test somehow how they stand there. Because I think that's for the future development, that's really crucial, but to develop both paths, because otherwise we will not get as fast as we would like to go there. And if I look at the overall market, I mean, it's always a question at which numbers you look, right? But I mean, also the green bond market, we will have in September, we will have a record month, and the ESG label market overall is still growing very fast. And despite of the fact that it's only a small part, the transition bonds, I think the impact might be, for the overall market, might be quite significant.
Okay, well, we're running out of time very quickly, but we have one question from the audience, which goes particularly nicely with the themes that everyone has just been talking about. Oh, apologies for siren. With the themes everyone has just been talking about a more holistic approach. And we have a question saying, if ESG labeled bonds are becoming, it's all about overall sustainability strategy, will ESG labeled bonds actually remain a meaningful asset class? Stephen, perhaps you could just give us a quick reply to that from your perspective before we wrap up.
I think that it would be great if they didn't, because maybe that would be an indication that everyone has started to incorporate within their own, again, their operations, their issuance patterns, a more sustainable, profile. But I do think that there's going to continue for the foreseeable future, certainly on the use of proceeds side, investors that are purely targeting an outcome, a direct and measurable outcome. And we're starting to see that expand away from even the green side now into more social and sustainability issues, where you're actually starting to see a combination of social outcomes being supported and enhanced by environmental outcomes as well. I think, as an example, one of the more interesting deals we've done recently was for a mobile home park out in California, in Sonoma County, where the homes, 87% of the residents there were low or very low income residents, very difficult to build and maintain affordable housing in that particular part of the country. But the owners of this particular park also recognizes the groups that they were serving and their clients, and were installing a solar array on grounds that's going to reduce the cost of power for the residents there by over 90% once operational. So I think that the ability to target and find unique investment opportunities where you're directing capital again is going to continue to be very important to investors. And I think that's one of the things that's not talked about as much on why ESG and impact investing has really surged the last few years, is that at this point in time, it's almost the purest way for an investor to control how their capital is being deployed and how it's being used. And I think that's very powerful for investors at this point in time.
Okay, well, I'm really sorry because I'm sure everyone has thoughts on that, and I wish we could come to everyone, but unfortunately we are now basically out of time, and the light is flashing at me. So I'll just say thank you very much indeed to all of our speakers for your time and input today, and thank you to all of you in our virtual audience for joining us. There will now be a short break, but please do tune in again at 12:30 London time for our spotlight session on social bonds. And I will be back tomorrow at 9:40 a.m. to moderate the panel on banks and sustainability. So please do join me for that. In the meantime, goodbye and thanks again for watching.